For more on the markets, we're going to cross over to the Johannesburg Stock Exchange. Nompumelelo Siziba standing by. Good afternoon, Nompumelelo. Over to you.
Thanks very much, Nzinga. Well, it looks as though there's been a broad global sell-off on equities, and the all-share index here in Johannesburg has been no exception. We see that down in the red, with financials in particular seemingly weighing more on the bourse than the other counters or the other sectors, which are also down. The local currency has lost a little bit of ground, but not really much to write home about. It's just a few cents relative to major currencies. I'm talking about the British pound, the US dollar and the euro. And after suffering a bit of a sell-off yesterday and the day before, we see that pharmaceutical firm Aspen seems to be clawing back those losses, up today 7% just alone today. Let's take a look at the indicators. Well, I'm joined by Brand Smith. He's from NEFG. Thank you for joining us, sir, and Happy New Year.
Thank you. Same to you.
Good stuff. Global equities looking mixed, but increasingly the trend seems to be more of a general sell-off. Your thoughts?
Yeah, look, it's a few basis points that they've been selling off over the last day or two. Look, they are expensive. There's a lot of good news that's priced into global equities at the moment. We had good news from tax plans in the US coming through, actually been stamped over the last few weeks. That's of course fueled massive rallies in the US markets and across the globe. So yeah, it should be a bit of maybe a warning sign for some people out there. Markets are getting a bit expensive, and I think they're getting a bit ahead of themselves in some of the global markets.
What measure do you use to work out how far you can go? Because if you sell out too soon, you might miss out on further profit. Yeah,
look, it's always more important to preserve capital. So we've been thinking that the US markets are expensive for the last 6 months or so. The CAPE ratio is one of the ratios that we use there, and it's been the most expensive in the US, only 2 times more expensive in previous 100 years history. So it is expensive. They normally, a bull market don't die itself. It gets clobbered by somebody, and we think it will probably be the Fed this year. So you're seeing inflation coming back. You saw oil prices rising. That might be the start of a new trend in the markets going forward. So if the Fed hikes more than expected, then you might see the end of the bull market that's lasted from 2008. Okay. And then let's stick with the oil price that you've touched on. When you look at the current oil price, which is basically flirting with $70 a barrel, and you look at the movement in the rand, which is sort of range bound between, let's say, 12.30 and 12.40 or 12.50. Yeah. What's your prognosis for fuel prices and ultimately inflation and then interest rates? Yeah, it's very difficult because they swing so much. If you've asked me this a year back, I would have said we're hoping for interest rate cuts. We saw one that last year of 0.25 a cut. We thought they missed an opportunity to cut it another 0.25 at that next meeting. After that, we had the currency weakening quite substantially. And the oil price was intact at that stage. But over the last 3 months or so, the currency reversed with Mr. Ramaphosa winning the ANC conference, but the oil price going up by probably similar margins over the last month or two. So, yeah, probably on hold for interest rates going forward. The consumer are still in a bit of a pickle, so we don't have the demand equation right in the economy yet, and food inflation is still on the low side. So I'm not too much concerned about inflation. But the rosy picture on inflation and interest rates are probably a bit out of the door with the higher oil prices that are sustaining at the moment. Okay.
And then just tell me, I did mention to you off air that I had noticed that a number of property counters have been suffering massive losses today. Let me just itemize them. A company called Resilient down 19.8%, Fortress B down 18.27%, Green Bay 18%, another company called Nepiroc down 15%. Is there something specific to them that's causing them, to all bleed today? What's going on?
Yeah, look, there's a lot of rumors out there in the market at the moment, so it's very difficult to speculate on rumors. A company called Viceroy brought out a report on Steinhoff not long before the whole story unfolded in November, December, and they hinting towards another company in South Africa that they have for Q1 up, and they short sellers in the market. So a lot of people are speculating, and one of the companies that came up with these speculators are Resilient, because they do got a bit of a house of cards build up in their structures, and they pay about a bit more out than what they earn, and they issue a bit of shares from time to time. But it was one of the winning companies over the last 10 years in South Africa. So they own, within their portfolio, they own about, I think 40% of their assets are made up of listed instruments, which is made up of Green Bay, Rockcastle and Fortress. So that's why you would see people think that Resilient is the company that they are speculating about, that the other three do follow as well.
I see.
But in the last hour or so, all of them have recovered. They came out of a trading statement from Resilient and from Fortress, which doesn't look bad for those companies, but only time will tell.
Okay. No, thanks for that explanation. Now, we saw what people are dubbing the Ramaphosa rally on both the equities and the currency. What counters do you see, equity counters do you see this year being worth picking up? Because obviously last year the JSE rose by about 7%, at the top 40 17%, but obviously there were some losers. So are there some counters that one could pick up?
Yeah, look, the last month, a month back, you would have said all the banks were cheap. They've rallied handsomely over December. So they didn't look so cheap as they did, but they still look okay, some of them. But it's much more company specific, I think, this year than we'll have big sectors outperforming from that point of view. So it is getting more difficult to find value out there. Naspers and Richmond were probably the two culprits for the 17% upside last year that we had. But there is some local companies that do have some upside for us in the local market, which
Give
is
us
not
a flavour.
Well, we think Aspenwoods now is not too bad. There's a company called Refuted that doesn't look too expensive. There's a few from the local side that doesn't look too expensive that people haven't looked at. Pioneer Foods is another example that might have some upside with the wheat prices coming down, which is one of the huge inputs. Tongaat Hewlett is still looking cheap. So there is a lot of cheap SA Inc. stocks still available to investors.
Okay, all right, we're going to leave it there. Thank you for your insights as always, Brand. There he's giving us some insights on some possible stocks that he deems to be fairly cheap right now, worth picking up perhaps, with the hope that they'll accrue some profit for investors. Well, after a short break, Nzinga has more business news for you.